Welcome to the F16 annual review of Mahindra and Mahindra. When I think of last year, I am reminded of Manthan, the Hindi mythology story. As per this mythology, all forces of the universe had to collaborate together and churn the ocean of milk to get the nectar of immortality. It was a huge process which would not have been possible if not done by one and all of the forces. While the churning produced the nectar, it was preceded by the emergence of poison. Similarly, the last few years witnessed churn at global, domestic, industry and company level. Last year, the global churn was represented by low economic growth rate, low commodity and oil prices, varying directions of interest rate regime across nation, and uncertainty over British continuance in European Union. Collapse of many BRIC economies and migrations issues also were prominent. Churn at the domestic economy was represented by excellent macroeconomic conditions, yet not translating into demand growth. The benefit of low oil and commodity prices offset by poor global demand and second successive year of poor monsoon. While the government has been focusing on long-term measures to boost the economy, we had to bear some short-time pain in the process. All these had impact on the industry in which we operate. While tractor demand continued to be in the negative range for the second consecutive year, the auto industry also faced headwinds due to subdued rural demand. However, we at Mahindra, we have always demonstrated an internal strength, which helps us to tide over the difficult economic environment. This year was no different. We still have difficult external environment. The poor monsoon, expiry of fiscal benefits, drop in consumer demand, especially in rural region, and lower export due to global slowdown. We responded as we do by launching 14 products in auto and 2 in FES and many new offerings in agri segment of our business. In the tractor market, which witnessed 10% degrowth, we improved our market share by around 100 basis points. We continued our razor-sharp focus on cost control and working capital management. Of course, we were also supported and took benefit of the benign commodity and low oil prices. The last annual report was aptly titled Resilience, and we saw more of that resilience in action in the year FY16. Having set the context, now let me move on to the review of annual performance. Before that, I want to take a moment and talk about Q4, as to me it represents a shift and a positive momentum. Both auto and farm equipment sector registered double-digit growth in volume after 16 quarters. Revenues grew by 13% and EBITDA and PBT grew 26%. These augur well for the full year of FY16 and the future. Now come back to the full year of FY16. The tractor volumes were down by 8.8%. Our auto volumes, however, were higher at 6.3%, mainly due to launch of 14 new products in the segment. As a result, M&M plus MVML revenues for the year went up by 5.1% even in this turbulent environment. We saw improvement in profits and profitability measures as well. Due to the increase in revenue and improvement in operating margin by 90 basis points, we have seen our EBITDA move up by 13%. PBT before EI at 4,508 crores represents a growth of 12%. PAT after EI at 3,298 crores is lower than previous year figure of 3,423. However, that's because we had some one times in FY15. 300 crores sale of MES stake and some sale of investments in the previous year, and adjusting for these exceptional items, PAT shows a growth of 6.6%, which is higher than the revenue growth of 5%. The key takeaway is robust OPM and profitable revenue growth. As a result, our performance indicators have posted healthy increases. OPM, as I talked to you, has improved by 100 basis points during the year. Our ROCE remains at a healthy 17.4%. The increase in interest coverage ratio to 18.8% should give further comfort to our credit rating agencies and to our lenders, who have affirmed their credit rating of the company this year at the highest rating. The EPS calculated based on PAT adjusted for one-time income from sale of MES also grows to Rs 56 per share. I am also happy to note that our debt equity ratio is very comfortable as 0.17, with the net debt equity ratio even better at 0, which reflects our top-notch credit rating of AAA in domestic and sovereign rating equivalent in international markets. Coming to M&M consolidated results, the revenue growth at a robust 10% to 83,207 crores, EBITDA also growing at 10% in line with the revenue growth to 6,777 crores. PAT before EI grows even better at 12%, with the figure at 3,206 crores. Reflecting the churn in the environment, segment like real estate, aerospace and steel had a difficult year with degrowth both in revenue as well as results. The steel trading, farm equipment and financial services also saw headwinds but showed resilience each in their own way. Even in this churn, some segment had a stellar performance. The automotive sector grew by 8%, but the bottom line by a whopping 66%. Hospitality sector had a great year with a top line and bottom line doubling during the year. IT services segments similarly showed healthy increase in both top line and bottom line. This allowed the consolidated results to show a healthy top line and bottom line growth. To give some color to our listed company's performance, I am sharing with you the performance of TechM, Mahindra Finance, Life Spaces and Holidays. You can see that Q4 has been excellent and show a healthy bottom line on a full year basis. The group has always strived for value creation for its investor with the listing of its businesses at an opportune time. The group market cap, which includes M&M and the listed entities only of the group, has seen a 23x growth in last 11 years. And over a period of 21 years, the growth have been even better at 108x. Finally, let me share the value created for the investor of Mahindra and Mahindra. It has surpassed all other indices. It has constantly beaten the Sensex and the gold return over different time periods. As we walk into the future, the headwinds like the end of fiscal benefits, higher tax rate, margins pressure due to new launches has been counterbalanced by the improving macroeconomic scenario, the complete product portfolio both in FES and auto, and these tailwinds augur well for getting the Amrit from the Manthan. I feel a good monsoon would be nothing less than Amrit to the parched lands and subdued rural sentiments.